Hello and welcome to another episode of Trading Blows from Trader X. A busy show this week with plenty for the panel to get their teeth into, including last week's inflation surprise out of the United States and the shaky risk appetite that we've seen since, whether the hawkish Fed repricing has now run its course, and if so, what that means for the dollar going forwards, the fact that sterling and the euro are still struggling despite some solid data and a continued repricing of the rates curve here in Europe as well. And we also dig into the divergences that are driving the no landing theory behind the US economy. Without further ado, let's get into things. So, as I said, a busy show ahead this week once more. Let's meet our panelists who are going to go head-to-head, as always, over 4 rounds, scoring points for a great response and having the threat of points being chalked off looming over them if a dispute is raised over their answer. The better the answer, and the more actionable trade ideas they give, the more points they will get. On that note, and because he's been complaining so much, we will give David a bonus point to start with after his brilliant calls on the Aussie dollar and on Tesla of late. So David Belle, founder of Macrodesiac, a macro analysis service. Alongside him, Richard Matthews, a founder of Pardus FX, specialist FX provider for corporate, institutional and high net worth clients. And making up the panel, Arno, a market analyst at Financial Source, a developer of proprietary trade idea generation and market analysis tools. With all of that said, and with David's bonus point on the board, let's get on with the first round. So, Dick, I'm going to start with you here because I know you've got some pretty significant and interesting views on the matter of inflation and whether the market has become a little bit too complacent around things. Obviously, we had that significantly hotter than expected core PCE number on Friday, 4.7% against the 4.3 consensus, and the prior, which was at 4.4. So that's put a bit of a cat among the pigeons. Do you think this is a wake-up call for both markets and the Fed, that the battle against inflation is far from over and that we're in for a little bit more downside in the equity market as a result?
A very long question. Good morning to you all. As I've been saying ad infinitum, that the battle for inflation was way from being over. People looking for pivot much too soon last year. We have never been in the position where we've had a pandemic followed by a war. People don't know what to expect. I think supply chains are still out of kilter. Certainly over here, as we go to the shops, that we notice that the shelves are empty of all sorts of things, from tomatoes in my local shop. Not that you should be eating tomatoes and lettuce in the winter, but then I'm old and I grew up eating turnips. It doesn't do me any harm. I just think supply chains are still out of kilter. As I've been saying, the market has just got this wrong. They want to believe the Fed's going to pivot. That's the recipe they want to hear. And it's not. I actually think that you're going to see another 4 moves upwards, and the market isn't pricing it in yet. And what's really strange to me is looking at the 10-year in the US, looks very, very cheap. And I think you can see that sell off quite a lot more. It's a big gap between that and Fed funds. So I'd be looking to short the 10-year. And I'd also be looking at back-month futures markets in the US and looking at some of the spreads there in the red months.
No, good stuff. Well, we're going to get on to the Fed and that hawkish repricing a little bit more in a second. Oh, no, I'm keen to come to you because obviously the data coming out of the US, the hot CPI number, the hot PPI number, and the re-acceleration that we've seen in the PCE gauge as well. Do you think this is something that we're going to start to see in other developed economies as well? And we're going to start to see not necessarily a smooth return to 2%, but a very, very bumpy and lumpy return down to 2%, which could take quite some considerable period of time?
Yeah, I mean, it's the divergence between the US and other economies is quite interesting. I mean, when we look at the US specifically, right, we had some interesting data. I think the market was both right and wrong, though, when we take a look at the recent data. They were right in the sense that they believed in a deflation environment. And if you look at the year-over-year numbers, they were right in that sense, because if you look at the CPI, the PCE, the PPI, we have decelerated on a year-over-year basis since we hit peak a couple of months ago. Where I think they got caught out, though, is how smooth and how how smooth and how quick that road would be. Because if you take a look at the 3-month annualized measures, on that measure, all of them reaccelerated to the upside. Now, in terms of how the markets reacted, is I think when you look at the reaction, it wouldn't have been as punchy if it wasn't for the labor and the soft data as well. I think the markets would have been able to look through the recent data slightly better if we didn't get that massive jobs print, if we didn't get the soft data reaccelerate to the upside. So right now, I think that the danger for the US specifically for inflation is that as long as the labor market stays solid, as long as soft data continues to bounce, that's going to mean more resilience for things like inflation. The challenge for other jurisdictions is that they don't have that same demand input that we're seeing from the US side with labor, with things like wages. Again, the UK, there's a little bit of wages included there as well, but it's not the same problem from a demand perspective. So I'm quite surprised to see inflation in jurisdictions like the UK and the Eurozone stay as sticky because they don't have that same type of demand input like we see from the US side. So it's a really tricky one to navigate in the data right now.
No, definitely. Well, David, how do we navigate all of this? Plenty to chew over, and Arno has thrown a ton of data at us. How do we make sense of that, and what's the trade off the back of it?
Well, I think as I've been saying over the last couple of weeks, and thanks for the extra single point. I'm pretty sure it deserved more than that, but I'll let it.
Well, be careful, I'll take it up again.
The thought that counts. But no, I think, as I've been saying the last couple of weeks, is that there's so much data out, and trying to make sense of the data from a narrative perspective is largely quite difficult. So I've been mainly focused on looking at what the market is pricing for the terminal rate. And that, the repricing since mid-Jan has just been ridiculous. We're looking at 5.6% now. So rather than trying to determine, is the Fed more concerned about PCE? Is it more concerned about CPI? Where's headline going? Where's, wages going? All of this. My priority has been, okay, what does the market actually think via, what's being priced in short-term interest rates? One easy way to look at this is via the quick strike tool on the CME. They provide a historical change in interest rate pricing. If you look at the Fed funds futures, and it's a fantastic tool, and you can see it really, really well. Like the curve has just changed so drastically in the last month and a half that it's literally got a breakneck speed. And I think this is now why we're seeing equities reprice lower as well. Obviously, they're starting to re-believe that inflation's a little bit stickier than they first thought. I do think that it maintains up to about 6%. I don't think the repricing's done yet. And the biggest shock will be if it goes beyond 6%, which is very, very possible because employment is still sticky. And I think that's the last sort of frontier that the market has to overcome. Until employment starts ticking down, I think there's really no reason for inflation to not maintain higher, well above Fed's target.
Well, hold that thought, and we're actually going to move on to the second round, because in that round, I want to really dig into that hawkish repricing, whether it's run its course or whether there's more left in the tank. But I can see Dick furiously shuffling his notes there around this, but we're going to go to Arno first in this round. As David said, and he's rather helpfully done my job for me there in terms of introducing this, the hawkish repricing that we've seen in the futures curve in the US for Fed expectations has been ridiculously rapid. I mean, at the start of the month, before the February FOMC, we were pricing a terminal rate of around 5%. You look this morning, we're pricing a terminal rate around 5.6%. So a really significant repricing. We've got 3 hikes in the curve now for March, May, and for June. And the more significant thing, I think, is not only are we pricing higher, but we're also pricing for longer, because the market at one point was pricing 50 basis points worth of cuts by the end of the year. Now it prices in about 10. So it's priced out pretty much all chance of any loosening by the end of the year. Well, what I'm keen to get your thoughts on, Arno, but before we go to the rest of the panel is, do you think this has run its course, or do you think there is more left in the tank for the market to say, actually, the Fed might hike beyond June? We might get a terminal rate nearer 6% than 5.5%.
So personally, I think what we've seen over the last, let's just call it 3.5 weeks, I think personally this looks adequate for the data that we've had until now. I mean, the markets were way too complacent. We know that, not just on the inflation side, but like I mentioned, I think on the growth and the labor side as well. I think that complacency has been reflected. I mean, if you take a look at the basis point increase we've had in 10s and 2s alone, that's been massive. Money market repricing has been huge. Equities are down. The dollar is up. I think a lot of the short-term angst about this, in my personal opinion, looks a little bit overdone. However, again, it's going to be down to the data, right? If the data continues to come in strong, we've got CPI coming up 2 weeks' time. We've got the new NFP coming up. I think it's next week Friday. If the data continues on the same trend, there's no reason for us not to get close to 2, maybe even above, close to 6 or above 6, like Dave said. The real challenge here, though, comes in again with the data, is that it's very difficult for me right now to take a short position on equities or a long position on the dollar and just keep it there, because firstly, I think a lot of that is priced. Secondly, it's only going to, imagine what's going to happen next week, Friday, if NFP comes in and we print 100,000 or 90,000 on the headline. You can see just as aggressive repricing we've seen in the last 3 weeks, we can see it go the other way just as fast as we've seen this repricing go. So for me, I've said it over the last couple of episodes, but I still maintain that the best way to trade this, in my opinion, is short term as a trader. And I'll be looking for big upside surprises in the economic data to trade the dollar higher or equities lower. And I'll be looking at big downside surprises or misses in the data to look for upside equities, downside in the US dollar. At this current juncture, though, or let's say intra-week, if you will, my bias wouldn't really be to chase the dollar or equities, dollar higher or equities lower on a beat. I know we're getting to the ISM data in a second, so I won't touch on that. I won't be chasing it. If we do see a big miss in the data, I think some short-term mean reversion trades looks attractive at these levels based on what's been priced in. But in the nutshell, I think for now, I think a lot is in the price, but it's going to be down to the data. If the data comes in hot, there's no reason we can't go above 6. But if it turns around a lot faster than what the markets are pricing in, we can easily see this that's been priced out again. So I think we need to stay nimble as much as possible right now.
I think Arno could have a future career in monetary policy and in central banking. The number of times he said data dependent in that answer, very reminiscent of Jay Powell or someone like that. David, where do you sit with this? You obviously brought the subject up in the last round. Do you think this has pretty much run its course now? The terminal rate is about right. The lack of cuts in the back half of the year is about right, and as a result, the pain for stocks might be over, and we might be getting close to a peak in the dollar as well.
No, quite frankly, I think
well, that's very blunt, isn't it?
About the potential for the data to reprice just the same aggressive way that we've already seen, but. I don't think it's over just yet. I think the market currently, as I mentioned previously, it's kind of re-believing what's going on. And an interesting trade that came on last week was an absolutely huge treasury flattener. Let me just get it up here. So it was 38,200 ZT M3 bought for 20,200 ZM M3 sold. So that's a huge block trade, a massive flattener. I think, once we start seeing these kind of flows come into the market, they tend to, it's not going to be picked up by a lot of people, but a lot of people aren't really going to notice it. But if you start seeing those big trades come through, you kind of start thinking, okay, why is that being bought up? And one of the issues with, looking at, say, the 2s, 10s curve or something like that, and indicating that there's a recessionary sort of condition coming up, is that the actual recession occurs once the curve's fully inverted. And I think this is what that trade is kind of signifying, is that, yes, we are we're facing some issues, but it's not just yet. I think there's a long way to go. And I think it's a fantastic trade, personally, that flattener. But I think that comes in 2024. I think that, real recessionary conditions comes in 2024. So until then, I'd argue that, the dollar maintains a bit in line with sort of this similar trade structure. And we do see equities come off further. I don't see how we don't, quite frankly.
Are you on board with that, Dick? More dollar gains, more equity softness to come, or would you be taking the other side?
No, I actually agree with David. I think the dollar stays strong. I still would want to probably be short of equities, although at the moment I would just be scalping the market. And I'd be scalping the market, looking to scalp on the upside on the dollar and on the downside on equities. I actually think that you will get more tightening. I think you're going to get another 4 hikes, March, May, June, July. And they will tighten until the pips really, really squeak, which will push us into recession. There's not going to be a Goldilocks. There's going to be no happy ending to this. They will push and push and push until we get into recession, unless they decide to ignore this 2% target and just say some random New Zealander made this up 5 years ago. 2% is nothing. We're now going to change our inflation target from 2 to 4% and just have a random number of 2 to 4%. That then gets them out of the hole. It gives them an opportunity not to tighten quite as much as they want to. So you may see that starting to be talked about later in the year, because it just seems, unless they do that, they will push us in, or they will push the states into such a hard recession. One other thing, I'm a big fan of the 2s, 10s and watching the 2s, 10s indicating the recession coming. The odd thing is, though, that a dozen eggs now costs more than a pound of chuck steak in America. So I'm told. I don't know what chuck steak is. I personally don't like chuck steak. Not that I know what it is. And a year ago, you would never believe if someone said to you a dozen eggs is going to cost you more than a pound of steak or half a kilo of steak. So has the economy changed so much that the 2s, 10s are no longer relevant? I just put that out there. And whether it's just so distorted, we can't read anything too much into these figures.
Yeah, on that point, I think the composition of the ownership of treasuries does actually distort the treasury spreads quite a bit, and the treasury curves. I think, obviously, the Fed owning so much, even Japanese pension funds owning so much, it creates a big distortion over previous periods where, we might have been able to have a better gauge. But even at that, we can still probably note then, from bringing in other variables, if the curve reverts, about 9 to 18 months later, we tend to get recession. It's happened all throughout time. So it's like, okay, I quite like that strike rate.
It's also important to note, when you look at the inversion, it's normally not the inversion itself. The way to know how far away we are from recession, we actually need to look at when it starts to re-steepen again. Because if you take a look at the recent history over the last, over the last 4 decades, take a look at all of the inversions that we've had. It's the inversion, it's then the re-steepening, and it's a couple of months after the re-steepening has taken place, then the recession hits. And normally the reason for that re-steepening is twofold. Firstly, it's obviously the Fed giving a signal that they are either done or potentially looking towards cutting. That obviously sees the 10s dropping a lot faster than the 2s dropping a lot faster than the 10s. The other reason, though, is if you take a look at the history of the data, is that within that re-steepening, there's normally that hopes of a bounce. There's that hopes that, hey, maybe things aren't so bad. The data is looking slightly better on the soft data. At that time, you've already had the hard data pretty bad, though, which is slightly different from our current situation. But I think it's the re-steepening that's the most interesting part for me currently, not really how far or deep we are inverted at this stage.
No, I think you're right. Dick, I just want to wrap up the round with you and go back to something you said earlier. 4 hikes from the Fed. If that comes off and we get to 6% and they do tip the economy into a recession or get very, very close to it, are you not in the necessarily the higher for longer camp, but in the we get high and very quickly we start easing policy again because the economy can't hold up to it camp?
No, I'm in the higher for longer, still at 6%. And I think you're entering a new era of higher interest rates. I don't see them coming back much below 4%.
Yeah. Well, it's a bold call, but I think you are probably onto something with that. Without further ado, we're halfway through the show, so let's get on to the third round. So we've spent quite a lot of time talking about the States. I want to get over to this side of the Atlantic and have a look at what's going on here in Europe and in the UK as well, because we had some quite good data last week. Both UK and Eurozone PMIs surprising nicely to the upside. The services gauge in the UK hitting an 8-month high, the composite gauge in Europe hitting a 9-month high. And this, along with a couple of other factors, we've had some hotter inflation data out of Europe as well, has really seen this hawkish repricing on this side of the pond as well. The market now expects 25 basis points from the 25 basis point hikes, from the Bank of England between now and August. The market's also now pushed back its estimate of the ECB terminal rate into 2024 and expects that to hit 4%. But what's interesting is, despite the curve steepening so significantly in terms of rates, and despite gilts and bunds selling off pretty significantly as well, both the pound and the euro haven't really managed to find much love despite all of this. So what I really want to discuss is, if the pound and the euro can't rally on good data and they can't rally on this hawkish repricing, what can make them rally? And David, let's start with you.
I think that's a bit of a difficult question, because you're talking about two currencies with very different dynamics there. You know, you're talking about one currency that is very, very correlated with risk, which is the pound. And then you're talking about the euro, which, you know, has actually been rather a funding currency for a while now. So I still think those dynamics are at play, especially considering, although we've had this recent hawkishness from the ECB, traditionally they've been very, very dovish, right? And I still think that psychology plays into the euro, especially when you look at emerging market equity flows and, you know, maybe the reversion of certain trades there back into the euro, for example. So there's very strange dynamics occurring there. But at the moment, I'm short the euro pound. I know I said to Dick a couple of weeks ago, it was a couple of weeks ago now, and I was agreeing with Dick that I'd be long euro pound. But something just over this new Windsor Agreement led me to think that it was more beneficial for the UK than it was for the EU, because any kind of concession at a time of actual quite weakness within the EU just shows a little bit more, just a tiny bit more political disintegration. Because if we just strip it down to what it is, it's really showing that the Good Friday Agreement could win, and that, you know, previous UK historical agreements could win and supersede anything that the EU is doing. Which I think, at a time when Poland is angry with the EU, Germany's weak, Poland's angry with the EU. You know, there's all the conflict going on in Ukraine. You know, there's criticism of Germany, even criticism of France, stuff going on in France to do with pensions, etc., which, you know, isn't necessarily uncommon. But it's just something else to weaken the whole political infrastructure, and not economic. The euro is an entirely political project and an entirely political thing, not economic. It just weakens the whole thing. And, you know, they've got to reintroduce the fiscal rules at some point. They can't not. I think Lindner in Germany, finance minister, he's already said that, you know, they have to start looking at the fiscal elements. It just doesn't look like a very pretty next 9 months. I don't think 2023 is going to be great for the Eurozone, personally. So even though it seems like the UK is quite weak, I think there's broader issues to do with politics and also the economy within the Eurozone, which makes pound probably for me now, I know I've changed my mind within the last 2 weeks, it makes it a stronger bet versus the euro, only versus the euro though. If we're talking about cable, I'd be short cable.
Yeah, no, I think you're absolutely right. I mean, you know, the Eurozone does have a lot of frailties within the bloc, and they are again coming to the fore. Arno, what are your thoughts on this? Do you agree with David's kind of medium, longer run bearish euro outlook, or do you think the UK is in just as bad a place?
Look, I mean, we've talked about euro sterling quite a lot recently. I think for me, it's a lot more simpler than that. It's not really tilted towards the political one. For me, it's really just looking at where I think the markets were offside. And if you take a look at last week's PMI reaction to euro sterling specifically, I mean, you mentioned that both currencies haven't really been able to gain ground on better data. But if you look at it on the index level, they just didn't gain against the dollar. They basically gained in the aggregate across most of the other major currencies. So it's just the dollar that was resilient. They didn't gain against the dollar, but they actually did gain some ground. For me, though, again, it's a lot more simple. It's just the fact that I think the markets got way too pessimistic on the UK economy too quick. And the recent data has just shown them to be slightly offside in that view, saying that, hey, if your base case is this massive bleak outlook, and you see PMIs looking like last week, that shuffles some of that sentiment around. And I think what happened yesterday was basically just another thing coming out that means that it's not going to be as bad as we thought it was going to be just 2 months ago, just 3 months ago. So for me, it's more of a sentiment play, if anything. And the way that I take that back to euro sterling, even though both economies are still in a tough spot, I just think that so much goodness was priced into the euro too quick from the start of the year. Everybody was super bullish on it. I mean, we've got the terminal rate sitting at, I think, 3.9% after today's French HICP data, which seems way too aggressive for the market. So I just think that the markets came into this year way too optimistic on euro, way too pessimistic on sterling. And I think some of that is now just making its way out of the system. And if the data continues, which I hope it will, because I'm completely on board with David with the short euro sterling, like if the data continues with this trend, I think there's more room to run for this to the downside. Euro sterling, that is.
Yeah, no, definitely. Dick, I want to bring you in, and particularly I want to talk about the Bank of England. I mean, obviously, you've got some very strong views on the subject. Obviously, after the February meeting, I think everyone, myself included, was saying, that'll be it in March. We'll get 25 basis points next month, and then that'll be it. Now the market is pricing a drastically different path to what it was just 3 or 4 weeks ago. Who do you think's right? Do you think we are going to get this end to the tightening cycle in March, or do you think we carry on? And whatever happens, I guess we expect the BOE to make a complete pig's ear of it in any case.
That's the basic outcome. The clowns in Threadneedle Street. We've got 3 of them talking today, haven't we? We've got Cunliffe, Pill and Mann. God only knows how they'll contradict themselves. One will probably want to lower rates, one will want to push rates up, one will want to leave them the same. I saw an inflation number this morning of grocery prices in the UK are rising at 17.1% now. I don't need to tell you or David about how prices are rising. They are much, much more aggressively rising than the Bank of England is going to be prepared to move interest rates. You might get another 25 after the next 25. I think they will then call it a day. I think they're so scared of what happens to the housing market and destroying their golden nest eggs that they won't actually act quickly enough to calm inflation. I think it's a really big problem and much bigger than the Bank of England's acknowledging. Just going back to the Windsor Agreement, which I absolutely loathe the title of this. This is playing to the DUP to keep people happy. And I'm really upset that King Charles got involved in this because the monarchy should be above politics. But besides that, it's 30,000 pages. And I bet you it's 29,900 pages of fudge, because that's what the EU and Sunak will do. I'm not convinced that it's going to be quite as good as everyone's saying. I don't see how actually it benefits the pound at all. It's a tiny proportion of trade. Maybe it helps some flows. Maybe it helps businesses in Europe coming through the UK for transportation reasons. I'm very, very cynical of what it will do for the pound. And in actual fact, I think that Sunak, as I said recently, is playing with absolute fire. He's now riding Boris Johnson and the ERG, the real hardcore Brexiteers. And I think you might see Sunak coming increasingly under pressure. A real cynic would say he's making this play before the local elections in May, which the Conservatives are going to get absolutely mullered in. So I think that he's played his hand, he's played it too soon. He's going to get attacked on that. There's no geopolitical tail risk in sterling at all. So I would be short of sterling against the euro still. and I'd be short of sterling and the euro against the dollar.
I think it's tough to argue with that, but punchy views on Sunak nonetheless. With that said,
you want to hear me talk about Bailey?
Well, let's not get onto him. He speaks on Wednesday. Blimey. Let's get into the last round then. Yes, BOE Governor Andrew Bailey speaking Wednesday, but probably more importantly, Wednesday and also Friday, we get the latest round of PMI data. We've got final prints from Europe and the UK, and we've also got the only print that we get from the ISM over in the States. What interests me about the PMI data at the moment and about economic data more broadly is that we see the services sector and the consumer doing very, very well indeed. Services PMI is coming in strong, the labour market holding up. If you look at retail sales, they're bubbling along okay as well. Even here in the UK, retail sales beat expectations in January. But then when you look at the other side of the economy, when you look at industry and when you look at manufacturing, there's a bit of a divergence going on. The manufacturing sector is not quite on board with this resilience and this recovery idea. Industrial production is facing some headwinds. The manufacturing PMIs pretty much globally are still below 50 and in contractionary territory. And what this is leaving me to wonder is that everyone seems to be jumping on this idea of a soft landing or of no landing. I think I tweeted out a Bloomberg survey on Tuesday morning, and I think it was something like 40% expect a soft landing, 20% expect no landing. I may have got those numbers slightly wrong there with a rounding error. But what I really want to get into is that if this is all based on the services sector, if this is all based on consumer spending, how fragile does this make the economy that we're currently seeing? Dick, let's go to you first.
I think it's very fragile. I think a lot of the consumer spending is being put on credit cards, and they're buying now before prices go up. Let's get it on board. And they haven't actually got the cash to spend, and they're spending it on credit cards, which I think makes it incredibly fragile. And as rates go up, it hurts more and more and more. I think as interesting as the ISM is the housing market that's pretty resilient in the States. Maybe that would give people a little bit of comfort. But I think it's a very, very fragile number to look at. And manufacturing is probably giving you a truer picture of the economy.
Yeah, no, I would agree with that. David, would you say there's any particular sectors that we should be looking at in the equity market or any even single stocks, given your brilliant track record of that lately with your Tesla call, that we should be looking at given this sort of underlying fragility that may be persisting in the economy?
I think there's some good dividend plays out there, actually. Just being cash. I see loads of people talking about cash, and you can go and just sit on the sidelines, but there's definitely some opportunities out there. Even in the UK, like I noticed Glencore has a fantastic dividend at the moment. I think it's up at like 18%, something like that, dividend yield. I can't remember exactly, but it's something like that. And there's some other quite strong plays out there in the UK as well. Rolls-Royce, for example, doing quite well. So I don't think there's any kind of real reason to be totally in cash. But at the same time, punting about in equities in this market, I don't think is the right play. I think you have to extend your time horizon a bit more. And perhaps look at, FX, for example, for me is great. There's a nice bit of volatility in there at the moment with some headlines coming out. But that's kind of probably more shorter term. But if you're looking at longer term, I said these anyway. But there are some good singles out there, and the two that I mentioned are probably worth a look at. Glencore has actually hit its IPO price. It's had an awful 12 years, but it's had a fantastic sort of last 3 or 4 years. But yeah, a massive dividend there to be made. Obviously, there's likely some issues with getting into a commodities stock, but I still quite like it. And also, there's things to do with nuclear, green energy, things like that as well. Not so much green energy, but batteries and stuff like that. All fantastic plays in my.
Yeah, no, I think that's an interesting idea. Arno, something I want to dig in with you. David mentioned the FX market. What do you reckon is a good vehicle by which to play this theme in the FX space? Decent services, disappointing manufacturing. Do you play this on a country data dependent way, or are there, are we going to see some haven demand come through and some weakness in the higher beta currencies perhaps?
I think right now, mate, for me, the simplest way that I can see that edge playing out, and the way that we've been, trying to take advantage of that, is just using the dollar as the best proxy for that. So there's so many currencies that you can choose to trade against it. Obviously, at this stage, I think the euro and the Aussie would be my favorites to trade against the dollar. But my play with things like ISM, whether it's manufacturing or services, if it comes in super, super strong, I would expect opportunities to trade the dollar higher. If it comes in very, very weak, I'll just be looking for short-term opportunities to trade it lower. I think this week, the PMIs, the ISM specifically, will be really interesting, right? Because we had, like you said, manufacturing coming in low last time around, but services had, I think it's the biggest 1 month jump in new orders like that I've ever seen. I don't think I've ever seen that type of jump on a 1 month basis. It was massive. So what will be interesting to see is whether that trend continues, because I think there could be a lot of short-term volatility that's very tradable, especially for the traders out there. If we can see that services number revert meaningfully, even if it stays positive, if it comes in and it gives back a lot of the prior gains for whatever reason, I mean the data has been so volatile. I'm not one to say that it is going to come in low or it is going to come in higher. Just be prepared for big volatility swings if it is a big deviation, and it's certainly possible. I think that's the best way to play it. If you really wanted to be very, careful or more specific, my favorite one was actually is still euro sterling. Looking at upside surprises in UK PMIs versus downside of flat surprises or flat or negative surprises in the eurozone. I think that's the most attractive way to play it. But intra-week for this week with the ISMs in focus, it's just the dollar. I think that's going to be your cleanest play from an FX perspective.
No, I think it's tough to argue with that. And on that brilliant note, let's have a look at the final scores on the doors this week. Well, against all odds, Dick has somehow pulled it out of the bag. I think those 3 wooden spoons you've got, you need to stem one. It must be the tie. I think you need to stem one of those wooden spoons down to Arno in South Africa, mate.
On the way.
Well, brilliant. Thank you, as always, for joining me, gents. David Belle from Macrodesiac, Richard Matthews from Pardus FX, and Arno Venter from Financial Source. Thank you also to Kyriakos, our producer, as always, for pulling this together. And thank you for watching. We will be back again this time next week. Let us know how you're trading the markets in the comments below, and we will speak to you then. Thanks, as always, and goodbye for now.